UBS reported fourth quarter pre-tax profit of $862 million, falling short of analysts' expectations, sending shares down by more than 4%. Its wealth management division posted outflows of nearly $8 billion, and the investment bank saw a $47 million loss. Joining me now is Gildas Surry, portfolio manager at Axiom. Gildas, thanks for coming in. So, pretty weak set of results. What's driving the misses?
Yes, definitely this morning the tone was defensive on the analyst call, and ultimately the numbers disappointed the consensus, and also they were significantly down on the previous Q1 we had in 2018. Weak revenues was definitely pulling down profitability, and also some capital charges as RWAs were inflated on the market risk front, simply because the volatility that we've seen in Q4 was factored into the new market risk, what we call value at risk, the VaR computed on the stressed VaR and the regulatory VaR. And so ultimately that pushed up RWAs, and it pulled down the ultimate CET1 ratio that the market was expecting.
So do you think that the share price reaction was warranted because it's down about 4% on the day? Do you think that's an overreaction, or do you think that's kind of makes sense?
The last data point the market had was actually SocGen warning that investment banking revenues would be down 20% for their part in Q4. And just before Christmas as well, we had Natixis communicating on some losses related to autocalls or some complex equity derivatives products linked to the South Korean indices. And so the market was bracing for some bad news, but especially as you can argue that the business mix of UBS is more tilted to equity and FX rather than credit and fixed income. But ultimately that's where they actually underperformed, and that drove down the numbers on the revenue side.
So you pointed to the equity division there because UBS saw a double-digit percentage drop in its earnings in that division year on year, which I thought was quite interesting when you compare that with the performance of the US banks that we heard from last week. It was significantly worse, yet market conditions remain the same for all.
Exactly, but typically being a dollar balance sheet, like the US banks, and having a number of businesses being driven by this currency, has been a boon for US banks, as opposed to European banks, being driven by euros, where it is at the moment in terms of yield curve. It's definitely a tale of two halves.
So the fact that UBS is now switching to report in dollars, is that going to help the bank?
Slightly, you would argue, but ultimately their business is geared also towards Asia. And what we've seen is a cooling off in China, we've seen a slowdown in Asia, and also, given the market volatility we had at the end of Q4, a sort of caution, like communicated by customers, especially high net worth individuals in their private bank. And that's why also we've seen a number of their Lombard balances being reduced, simply just customers not willing to invest in these market conditions.
So we know that UBS, in particular the CEO Sergio Motti, since he took to the helm in 2011, has really been focusing on the wealth management and less so on the investment bank. And the investment bank this quarter posted a loss. It swung to a loss from the previous year. So in a way, does that kind of justify his decision to focus more on the wealth management division?
Definitely. And also that it's further supported by the move undertaken by Credit Suisse maybe 3 years later. And Credit Suisse is actually delivering on those targets. Credit Suisse did an investor day mid-December. UBS also did an investor day at the end of last year, and they reiterated their commitment to this business model where their priority is to strengthen their market share in private banking and also align all their other businesses, typically in the investment bank on FX, equity, credit, leveraged finance towards the needs of their private clients. So yes, I think it's definitely a confirmation that it was a good decision by Sergio Hermouti, and ultimately also the call, and Credit Suisse in their investment day reiterated their 12-13% capital targets, which are very unviable if you are a European investment bank to deliver this kind of return. So it's definitely an approval of his strategy.
What about the dividend, the share buybacks? We heard that the bank is planning to up its dividend to 0.7 Swiss francs from 0.65 year on year, so a slight increase. It's planning a $1 billion share buyback this year. How does that compare with your expectations?
Well, in fact, the wording they used is actually a copy and paste from the wording they used last year. So nothing has really changed actually on the share buyback.
Which is interesting because last quarter we heard from the CFO and he said Q4 was when we're going to really update the market about our dividend and buyback plans. But you're saying essentially it's just the same as it was before.
Exactly. Maybe the market was actually expecting a stronger and a bolder announcement. A bit like Credit Suisse Investor Day. Credit Suisse Investor Day, markets and analysts walked back from this Investor Day a bit disappointed. They were hoping for more. And maybe the market was actually hoping for more this morning. But 1 billion Swiss franc share buyback, it could be 1.5. So the quantum is still flexible, and I think it should be supportive for the shares. So that's why 4% down on the opening this morning was probably a bit severe. But especially as in the overall context of market conditions, they're in a position to go through this volatility and to capture also market shares. They've mentioned that they've been hiring FAs in Americas. Asia is probably slowing, but they've got a very strong and balanced business mix. So I would expect them to, from where they are at the moment, to continue delivering, against this profitability target of 13% of ROE.
So there's a number of sort of headwinds facing the whole sector from the fact that the ECB appears to be moving a lot slower than we thought several months ago. There's those geopolitical tensions, trade tensions, and of course Brexit. How do you think UBS stands to fare in and amongst all of those pressures when comparing it to its peers going ahead?
Well, I would say a bit of a safe haven. And if you add on to that governance, the way they dealt with this mini crisis with Andrea Orcel resigning to go to Santander, they've been dealing with this with a lot of discipline and in a principled manner. So I think not only the geographical footprint, but also the balanced business model, and on top of that the governance, they are definitely standing as an outlier. And that's what we see also in the valuation metrics. It trades in a normalized way with like 1.1 times tangible NAV, a bit more than 9 times 2019 earnings, and so it's very much of almost a safe haven in the wider context of European banking. Talking about ECB, the ECB on Thursday will have its first press conference of the year, and maybe we should expect some developments on TLTRO because they have to phase out the TLTRO2, and ultimately they should come up with another tool, whether it's a TLTRO3 or whether it's an incentive to actually manage down NPLs. We'll see, but as far as we are concerned at Axiom, we keep an open mind. Also, tactically, if Mario Draghi doesn't announce anything this week, he will have to wait early March to announce something. And then he's getting closer to the European Parliament elections. And so that's why maybe we should expect something on Thursday.
All right, so what's your top pick in this sector? Of course, UBS kicking off the European bank earnings season. We're waiting to hear from all the other banks, essentially, apart from SocGen last week. Deutsche Bank will be on the 1st of February, Santander on the 30th of January. Which stocks are you leaning towards?
And we do like UBS and Credit Suisse. UBS because of the maturity of its business model. Credit Suisse is just 3 or maybe 2 years behind, and ultimately it's not in the valuations yet. We also like SocGen. SocGen is definitely priced almost to imperfection at a discount of 50% to its book value. If you compare that to Natixis, that trades at a premium to its book value, it's definitely a mismatch. And that's where, that's the kind of stocks we would favor in this environment. There are some ongoing developments, happening at Danske Bank, Nordea on money laundering issues, Deutsche Bank on litigation, as we've seen this morning. So any investor, willing to deploy capital into those names need to be able to shoulder the volatility. But that's the names we...
And just finally on UBS, there's been some reports from Bloomberg that the bank could be looking at succession plans around the CEO, Sergio Amotti. What does that tell us about his leadership and how much longer he'll be in the role? What are your thoughts?
Well, he's been answering this question this morning, and he said that he has found the scenarios or the succession stories being mooted in the press as funny. I think it's very difficult to anticipate what a succession plan or a succession process will be. I think he is a very strong pair of hands at the moment at the helm. In a market like this one, I think it's probably better to wait a little bit rather than pushing for a succession. It's definitely not the type of, I would say, stress or crisis that we can see at Standard Chartered, for example, where Bill Winters is under the pressure of one of its main shareholders, Temasek. So no, I would not read too much into a new succession plan. They are looking for external talents, and so it's probably 3 or 4 years, ahead of what could be a succession for Mr. Amotti.
Gildas, thank you for your time.
Pleasure. Thank you.
That was Gildas Surry, Portfolio Manager at Axiom. I'm Victoria Scholar, and thank you for watching IGTV. We'll see you very soon.